All right, we wanted to create a video to walk you through some of the margin products that are out there in the insurance world. We'll talk specifically about margin protection and then a new product called MCO, Margin Coverage Option. We're going to go through just kind of a general overview of how they work, and then we'll deep dive into the variables that go into them, some of the subsidy changes that came out of the last bill, and then we'll kind of go through the margin coverage option there at the end. The reason we're talking about this right now is the sign-up deadline for these is September 30th. So at the end of this month, if we want to look at taking these products, we've actually got to sign up for the 2026 crop year. So they're a little bit ahead of our traditional revenue protection or springtime products. So that's why we're kind of looking at them ahead of time here and trying to get some information in front of you. So margin is a function of your revenue and your variable costs. So obviously we have revenue making up a big part of that. We're familiar with that from revenue protection. We have the price and the yield affecting our overall revenue. As far as costs go, we have fixed costs and we have variable costs. The biggest variable costs like fertilizer, seed, chemical, fuel, those are included in these margin products. And so that's what they're trying to protect. They're trying to protect against moves in those margin, in that margin. So if we look at this one, for example, we have expected revenue and we have actual fall price and actual county yield. Those are just like our county-based products like ECO and SCO, and just like our revenue protection. The costs, on the other hand, these are unique to the margin products. So we have expected variable costs, but then in the springtime, we'll have actual variable costs. So they're discovered in the spring. That's why we've got to sign up for them way ahead of time here in the previous fall. So here are those actual inputs that go into margin protection. Just going down the list, we've got diesel, DAP, urea, potash, machine, seed, and chemical, and then interest. All of those in the gray boxes here are discovered from August 15th to September 14th. So we are in the middle of the discovery window for the 2026 crops. Once we get to the springtime, then the diesel, DAP, and urea values are going to adjust to whatever those values are from April 1st to April 30th. The potash and the machine, seed, and chemical lines, they don't actually change from the fall to the spring. So those are just kind of some variable costs that are set in stone. Interest is another input. Interest is actually not discovered until October. You'll see these ones down here on the bottom. Interest, and then of course price and yield aren't discovered until harvest. So just like revenue protection, that price component is from October 1st to October 31st, and so is the interest rate. The interest rate is a function of the federal funds rate with like a 6% premium put onto it that they kind of figure as like representative of an operating note. The fertilizer values, DAP and urea, those are actually traded on the CME. They have published values here. Here's the DAP values today and the urea values. Those are traded on futures markets. There's not a lot of liquidity in them, so we can't really trade them from like a brokerage standpoint, but they are values that are somewhat representative of what's being traded. So that's how those are found. And then diesel, of course, is also traded on the futures market, and so that's how those prices are discovered. The county yields, expected and actuals, are going to be exactly the same yields that are used for your other products like your revenue protection and your SCO or ECO. They take those values, they multiply them by per acre quantities, and these quantities are derived from the yield. So if you have a county with a much higher expected yield, you're going to have much higher expected quantities of your fertilizer and diesel values. In Fremont County, for example, this is 2025 data, but they had an expected yield of 207. So I was just plugging that in there. If we slide over just a little bit, we take the prices, multiply it by the quantities to get our total costs per acre. So we've got all of those, the fuel and the fertilizer and the machine, seed, and chemical lines come down here to this total variable costs line. We take the variable costs and we subtract them from the total revenue. So total revenue, again, is just our price and our yield to get a total margin. So this is the margin in 2025. This was the margin that we would have expected in August through September in that discovery window back here. Harvest values, these are the values that are actually discovered for your fertilizer ones. These were here in the spring. And then interest and total revenue numbers will be discovered here in the fall. So you can see if we end up at $4 and county yield comes in at 207, we could expect a payment of about $64, depending on what level you took. Now, if we're expecting better yields, which we probably are here in Southwest Iowa, for example, that could actually result in no payment. Even though the price has declined, we can have a higher yield, which would offset, it would give us more revenue up here, and would not trigger a margin payment. Now, we can get a payment one of two ways. Either price and yield can come down, or let's just say, for example, back in the spring, that fertilizer just went crazy and we had $1,000 DAP values. That's going to jack up our input prices here in the spring, which is going to give us less total margin, which is going to result in a margin protection payment. Just some examples of ways that a margin protection payment could get triggered. If you look down here, this is just a quick chart about the weight of the margin protection inputs. So you can see that big machine, seed, and chemical line is over half of the value of your variable costs, and that actually doesn't change from the fall to the spring. So that's just a set cost that's set in stone. Potash doesn't change either, so you just got your urea, your DAP, your diesel, and your interest that are changing. So really only about what looks like about a third of the pie is actually changing from the fall to the spring. We'll get a little bit more into what that means as we get into MCO, but just something to keep in mind. So this is for 2025. If you took margin protection on corn in Fremont County, for example, this is the chart that we could kind of look at today. If let's say we're expecting a 225 in Fremont County and the market's around 420 right now, we're probably not expecting a payment based on the fertilizer values that were discovered in the spring. Now, it doesn't take much lower to get down into the $4 market where we could start to see a payment depending on how yield comes in. As we're thinking about the decision to take margin protection again, or maybe take it for the first time this year, it's important to look at what years had payments and why they had payments. So the payments that came in Fremont County, for example, and this is going to be different by county depending on yields, but just using Fremont County as an example, 2023, we had a pretty good sized payment. 2024 was a pretty good sized payment. But as you can see, those were both years where margin was much higher because we had much higher spring prices. I say spring prices, I mean the price that was discovered in this August to September window. So think about it, we're looking at over a year in advance. And so as the market was high in 22, 23, as the market came down, we were having larger margins further back in the calendar, which led us to ensure a bigger margin amount. We were of course going to pay more premium for that product, but then it resulted in a payment as the market came down and the prices came down. 2025 here, I left an asterisk because we don't know for sure, but it doesn't look like there should be a payment based on current market conditions and where yields might be expected, but we'll see how that pans out. For 2026, we would be looking at a very similar margin amount to what we paid for in 2025. So you can see costs down here on the bottom are up slightly, but so are values. We had a 440 corn price for 2025. The average corn price right now for 2026 is looking like around 455. With the big changes in the big beautiful bill, I think it's really important to talk about subsidy levels for all of these products, including margin protection and the new MCO product. So in 2024, all of these county-based supplemental products, including margin protection, were subsidized at around 44%, depending on what level you took. But if you took it at the highest level, you were getting a 44% subsidy. In 2025, they raised the subsidy for SCO and ECO up to 65%. That's why we talked a lot more about ECO in 2025, was that increased subsidy making it more relevant. In 2026, they actually are raising the SCO, ECO, and the new product. They're going to be 80% subsidized, along with your 75% enterprise revenue protection. Unfortunately, they're not applying that same subsidy increase to margin protection, So that's a really big jump in subsidy levels that is not getting applied to this margin product that historically has been subsidized at a pretty similar rate. You can see up here on the top, SCO, ECO, and margin were all on the same level, and now there's quite a pretty big discrepancy. They did increase subsidies for revenue protection in general, even if you're not taking a margin product or an SCO or an ECO, any of the supplementals. They did raise overall revenue protection subsidies by 3 to 5%, depending on the level. The biggest raises were here on the enterprise side. Those went from 76 to 77% up to 80. Up into the higher levels, they do peel back that subsidy a little bit, but they're still footing a good portion of that bill. And then I did want to mention one thing about beginning farmers. Beginning farmers are going to get even more subsidy increases than they had before. Before, it was just a 4-year deal, and they gave you an additional 10%. So for example, if you took 80%, 75% enterprise, they were going to give you 80% subsidy to begin with. They'd give you an additional 10 for being a beginning farmer. Now they came out and said, if you're in your first or second year, we're going to give you 15%. So that's another 5. So for example, a first or second year beginning farmer is only going to have to pay 5% of the premium on a revenue protection policy, and that could also include SCO and ECO. So a lot of really, really big benefits there for beginning farmers, so make sure you're on top of that. Make sure you're getting your paperwork filled out for that, and you're aware of your years of eligibility. That brings us into MCO. So to go back here, MCO, this new product here on the right hand side, also going to be subsidized at 80%. MCO functions a lot like margin protection. It has a lot of the same inputs, but it's a little bit different in the way it stacks up. So here on the left hand side, we've got margin protection. It sits next to a revenue protection policy, and you're paying for that full range of coverage. Including your revenue protection, there is some premium offset. So depending on how your yields correlate with the counties, they're going to discount your revenue protection policy if you take margin protection. What's different about the margin coverage option is that it stacks up on top of your existing RP policy. Along with your SCO, if you take SCO, it goes on top just like an ECO product. So we cannot take MCO and ECO, but we can take MCO partnered with an SCO. A lot of acronyms there, I know. But one more note over on the margin protection side, this premium does offset. The caveat there is that it also will offset your indemnities. So if you were to have a margin protection payment, but then you also received a revenue protection payment, those two payments are going to offset one another. And so you're not going to receive the full benefit of the two products as they exist separately. So let's get into some MCO calculations. This will look really similar to the margin protection slide because they have a lot of similar variables. On the input side, you've got diesel, DAP, urea, and potash, just like we did before. They did add in nat gas as a variable for irrigated corn only. So this is the new variable that they're using to kind of incorporate some of those irrigation costs instead of diesel where it was before. They also got rid of interest. They also got rid of the machine, seed, and chemical line. So the result is that now we've got a much more representative pie that's moving along with the variables as they change from the fall to the spring. So this was the margin protection chart that we looked at where machine, seed, and chemical stayed steady. This is the MCO margin coverage option chart where you can see all of your fertilizer DAP and urea make up darn near 2/3 of the pie. And then you've got potash and diesel making up the rest of it. There would also be some nat gas in here if it was irrigated corn. Let's slide back over here. These are 2025 values. So this is, it wasn't a product in 25, but if it was, these are the values it would have been. At 440, we would have had some increased costs. You can see DAP was cheaper in the fall than it was in the spring. Urea was cheaper in the fall than it was in the spring. Same with nat gas. So overall costs would have increased. Sliding over to 2026 values, these are the values that are being discovered right now. We're inside of that window today for diesel, DAP, urea, nat gas, and potash. The price so far has averaged about $4.54, and Fremont County, for example, has a $2.10 expected yield. For the harvest values, I just left those the same, just as hypotheticals. The per acre quantities are very similar to give you your per acre costs over here. So a similar layout. You'll notice the variable cost number is quite a bit lower though, because we took out near $200 of the machine, seed, and chemical expense. Here's the calculation. There's a lot of numbers down here on the bottom, but this is the calculation for how you calculate if a payment is triggered. So what we can do is mess with some variables over here on the left-hand side to get these variables to change. So right now, if variables all stayed the same, obviously there wouldn't be a payment for that county. If we increased the price of fertilizer, for example, like we did in the other slide, we could get ourselves into a situation where we had a payment. There we go. It took quite a big increase, but that's going to go to show my point here. This is a box that multiplies all of those inputs. Okay, so if we took all of those inputs times 10%, we still don't have a payment down here. If we took them all times 30%, still no payment. We have to see an increase of close to 40% of all of those inputs before we get into any payment territory, assuming that price and yield are held steady. If we change that back to 1 and we only change the price, let's just say we go to $4, there we are in payment territory already. So the point I'm trying to make here is that this margin calculation is a lot more sensitive to price and yield than it is to a change in the input values. It might visually make a little bit more sense to slide over here. There's obviously there's two sides to the equation, right? There's the input side and then there's the revenue side. Price and yield are two variables that are going to change and have 100% of the impact on the revenue side. Your margin is a really small sliver up at the very top of that total per acre revenue number. And so you can see visually how it would take a lot of change in these margin products to actually trigger a payment relative to price and yield. The reason I say that is that as we're deciding whether to take these products or not, a lot of times they have a lot of complexity to them, and the margin part of it is attractive because it can help protect against a rise in input costs. But the fact is, if you actually run the numbers and run some hypotheticals, you've got to have a really, really significant increase in your input cost to get into some kind of payment level. So this was just kind of a rundown of the two primary margin products. It's that time of year where agents are going to start talking about it, since the deadline to sign up is the end of September. If we can help you with that decision in any way, we can give you some quotes for your county specifically. We could plug in your farm's APHs and actually see how your inputs would stack up against a margin protection product. We can also talk about how this ties in with your marketing plan. We've talked extensively about how ECO, ARC, and PLC and these other programs all come together to make your risk management plan holistic. And we want to help you do that with these margin protection products as well, if that's something that you're looking at or if it's something that you've taken in the past. So please give us a call. We're happy to chat through them. Hope these are helpful videos for you. Thanks.